Hey guys, it's Hakeem here, welcome back to another video, and I figured that today it's about time that we spoke about the much polarizing stock that is Tesla. Now this is a video that was recommended for me to do by a regular viewer of the channel, so John, there's a shout out to you and thank you very much for that. Now Tesla is a stock that really does divide opinion. You've got the value investors on one side that are saying that anybody that is buying the company at the current prices simply doesn't know how to value a business, and anybody that is buying the business at this price, they're simply going to lose money. They look at the other automotive companies, they see that Tesla is worth more than maybe the top 10 or something like that, and they simply don't see how you can earn a return. You've then got the growth investors that are saying, actually, no, you guys are the idiots because you don't understand that Tesla isn't just an automotive company, it has other sectors as well. And also the growth of the business is like something that we've never ever seen before in the automotive industry. Now, my personal opinion is that I really hate the divide in the classification between value investors and growth investors. I think that by definition, every investor should be a value investor in the sense that we are looking to purchase companies that are undervalued. And that's how you see a return on your investment. Now, that's not to say that a company with a P/E ratio of 100, for example, cannot be undervalued if the growth suggests that the future cash flows provided by that business are worth more than the value of the business today. And so I think that every investment should be a value investment, and I really hate that split. Now, just before we dive into the actual analysis of the business, there's one thing that I should confess up front and hold my hands up to. And that is that I came into this research with an element of skepticism. And the reason for that is because the Tesla share price has increased by over 1,000% over the last 2 years. And generally speaking, whenever that happens, it's due to market exuberance and an overbearing market sentiment towards a particular stock. And generally speaking, when that happens, you're due a pullback because stocks generally shouldn't move that way. With that being said, when I've looked into the business further and understood the business even more, I've been really impressed with how they've managed to scale their operations and increase their efficiencies. And actually, I'm starting to see why people love this business so much and the potential that it has. Anyway, that's all I'll say for now, and let's dive into the analysis. So of course, one of the most obvious places to start is to look at the revenue growth of the business. And this starts to tell the story as to why we've seen this significant increase over that period of time. So back in 2016, Tesla finished with $7 billion of revenue. And at the end of 2021, we've got 1 quarter left to report, but we can pretty sure that it's going to fall around the $52 to $53 billion range. So that is an incredible growth, something like 50% on a compounded annual growth rate. So there aren't many businesses that continue to grow their business at 50% year over year over a 5-year period. So then it starts to give you an idea of why there is such an exuberance around this stock. Clearly, there's a lot of potential there, and actually Tesla is performing under that potential as well. Analysts are actually anticipating that Tesla is going to grow by a further 44% in 2022 to $75.5 billion. Now, just to give you a little bit of a hint, in my valuation model, I've actually included a bit of a higher growth rate than that. That's all I'll give away for now, and we'll get onto that shortly. But yeah, analysts are saying 44% growth over the next year, which is again incredible for a business that has been growing 50% over the last 5 years. But of course, as I always say, there's no point in growing your revenues aggressively if that's not going to translate into profits later on. But that's not the case with Tesla. We can see here that they actually posted a loss of $413 million in 2016. In 2021, we're expecting a profit of just under $7.2 billion. Now that growth is absolutely phenomenal. And that's the sort of thing I'm referring to when I talk about them scaling their operations whilst increasing their efficiencies. It's incredibly difficult to be able to do that. And yet Tesla are executing on that plan. So really, I'm impressed with how they're managing to do that. Once again, analysts are then estimating that in 2022, they're going to continue that level of growth up to $11 billion, and that's a change of 50%. So once again, we're expecting that net income is going to grow at a greater rate than what revenue is growing. So therefore you get the margin expansion and once again, increased efficiencies. Now, one of the key arguments that a lot of Tesla bulls make is that Tesla isn't just an automotive company and thus it shouldn't be valued as one. It's actually a technology company that sells cars, and thus the valuation that you apply to it has to be different to your standard automotive company. So I wanted to dig a little bit deeper into that. So we can see here that for Q3 2021, they achieved revenues of $13.7 billion. And we can see that the total automotive revenue was $12 billion. So around 88% of Tesla's revenue currently is automotive revenue. And as a result of that, I would sort of say that it is primarily an automotive company, right? With that being said, it clearly does have potential as they are scaling up their other operations. We're seeing significant growth in their energy generation and storage business, and we're also seeing significant growth in their services business. Now, that services business is insurance, and therefore that does relate to their car business, right? As they sell cars, they'll also be able to cross-sell to insurance as well. So I would say that services and other is actually largely related to their total automotive revenue, but it is a different service line, and therefore I'll give it a pass on this one. Energy generation and storage is completely unrelated, in my opinion, to the automotive business, and as a result of that, that seems completely fair. We're seeing a significant scale up of those two operations, and so there is the potential that over time, these verticals will become a larger part of the total business and therefore represent a larger pie in the total revenue that Tesla generates. Now, there's a couple of points to note from their outlook, and the first one being the volume of their deliveries. So we can see here that they plan to grow their manufacturing capacity as quickly as possible, and they're building the gigafactories in order to do that. I'm sure we're aware of that. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. The rate of growth will depend on our equipment capacity, operational efficiency, and the capacity and stability of the supply chain. So if they can grow at 50% on an average annual growth in vehicle deliveries, you can see how quickly that is going to ramp up. Now, we'll come on to vehicle deliveries in a moment. But just before that, they also say that we expect our operating margin will continue to grow over time, continuing to reach industry-leading levels with capacity expansion and localization plans underway. Now, having seen how quickly they've managed to scale their operations so far and increase those efficiencies, I have to say that I give them credit for that, and I probably agree that their margins will continue to increase, and that's what I incorporate into my model. So following on from that, I created this, which goes to show the vehicles delivered and the average selling price, and I use this to incorporate into my model. So we'll come on to the model in a moment, but we can see here how the total revenue has been ramping up, and these are the vehicles delivered. So in Q1 of 2020, they delivered 88,000 vehicles, and in Q4 of 2021, they delivered 308,000 vehicles, which is a compounded annual growth rate of 87%. So that is seriously impressive numbers of growth. Here's the automotive revenue that they've achieved, and this is the average selling price. So one thing to note here is that actually their average selling price, which we see as the green line on this chart here, has gone from around $58,000 to $50,000. So we have seen a decline in that average selling price, but that's not all that surprising actually. And the reason for that is because Elon Musk has always said that he wants to create a car that isn't necessarily a luxury vehicle, but actually is accessible to a lot of people. So he wants to try and bring down the cost of the car in order to reach a higher number of people. So that trend isn't actually that surprising. And then the blue bars on the chart here just go to show you the vehicles delivered, which once again is that 87% compounded annual growth rate. So seriously impressive figures. Now, automotive revenue as a total percentage of revenue, now this has actually been increasing, which sort of goes against the bull thesis that a lot of people put together, in that the other service lines are actually going to continue to contribute a greater amount over time than the standard car revenue, which typically operate at lower margins. Now, we've seen that go from 86% actually up to 88% over time. So that doesn't quite tie in with the overall bull thesis, but this is only a 2-year period. We need to try and consider what that's going to be over maybe 5-10 years. Now, of course, in terms of their potential and in terms of increasing their other revenues in comparison to just their automotive revenue, we've also got the potential for full self-driving subscriptions. Now, Tesla haven't quite managed to completely master this, but they are making progress. With that being said, Elon Musk has been promising full self-driving that effectively it will be coming next year since about 2017, and he continues to effectively push that back. And it's not that surprising, right? It's not an easy thing to achieve to have a full self-driving vehicle. The chances are that I think that they probably will achieve it, but I don't think it's as soon as what a lot of people think that it is. However, if they do achieve it, that's clearly going to be a massive driver of revenues, and also it's going to be a very high profit margin business. So we'll watch that space there, but I don't think it's as soon as what people think it is. So then that brings us on to my financial model for the business. So we can see here that in 2021, for the full year, I'm expecting $53.6 billion. Now, I've taken that figure from effectively taking Q1 to Q3 results and then considering what their Q4 deliveries were and then working back from there. So I think that they're going to achieve $53.6 billion. We'll see how close I am within about 10 days, I think. Now, for 2022, I've said that I think that the business is going to grow their revenues by 50% up to $80 billion. I've then said for years 2 and 3, I expect the business to grow at 40%, up to effectively $146 billion. Years 4 and 5 at 30%, and then years 6 to 10 at 20%. Now, it goes without saying that as a business grows and as they get larger and larger, it becomes increasingly more difficult to grow at the same rate. And as a result of that, we taper down that growth rate to reflect that. And if you think that that is a conservative growth estimate, well, then you have to understand that by 2031, that model suggests that we're going to be achieving revenues of $615 billion compared with $53 billion in 2021. So more than a 10x in terms of their revenue growth over 10 years. That's phenomenal growth, and I don't think it's too conservative. In fact, I would actually say that it's very bullish, and I think that Tesla has to execute on a lot of their promises in order to achieve that. Now, in terms of their gross margins, I've actually done this based on excluding their credits, their regulatory tax credits that they receive. And the reason for that is because over time, those credits are going to disappear as other companies enter the EV space. And so as a result of that, I don't want to include the benefit from those credits going forward. So you can see here from their latest quarterly results that they achieved gross margins excluding those credits of 28.8% in quarter 3. And actually they've been increasing that over time. So quarter over quarter, that has been increasing. As a result of that, I think for 2022, they can achieve 30%, and that increases through to 35% by 2025, where I think that actually then it starts to plateau, simply because of the type of business that it is. It generally is a low margin business, and actually 35% gross margins is very, very good for the type of business that they're operating in. Now, for operating expenses as a percentage of revenue, I've set a range between 10 and 12%, effectively starting at 12% and falling to 10%. You can see that they've increased their operational efficiency dramatically. So it was 32% as a percentage of revenue back in 2016, and that has fallen all the way to 13% in 2021. And actually from 2022, I'm expecting 12% to then fall to 11%, to then fall to 10%, where it then finally plateaus. Now, the weighted average cost of capital is quite high, and that's because it has a very high beta. And this is potentially a bit of a downfall in using a weighted average cost of capital and actually using a capital asset pricing model method to determine what your WACC should be. Now, capital asset pricing model is effectively this section here, but it relies on beta, which is a reflection of the volatility of a stock, in order to determine what effectively the cost of equity should be. Now, due to Tesla's high volatility, it has a relatively high weighted average cost of capital, sitting at 12.7%. So that's quite a high discount rate, but actually that probably falls in line with a lot of discount rates that people would use anyway. So I'm not too concerned with that. Now, in terms of what all of those numbers mean for the business, so as I said earlier, we go up to $615 billion in revenue by 2031. And also we increase our net profit margins from 12% in 2021 all the way up to 19% in 2031, which is a significant growth, and it's a significant increase in operational efficiencies. That would result in a net income by 2031 of $116 billion. Now, I appreciate that all of these are just numbers on a page, and so I thought that it would be helpful to try and demonstrate what that would look like in terms of vehicle deliveries and things like that. So in order to demonstrate that in a slightly more tangible way, I've come back to the vehicle deliveries section. And we can see here that for total revenue in 2026, I'm expecting that will be $247 billion and $615 billion in 2031. I've then considered what I believe the average selling price may be of a Tesla vehicle by 2026 by effectively just incorporating a slight price increase as well as some slight inflationary increases. So that takes the average selling price up to $64,000 by 2026 and $74,000 by 2031. Now, the sort of issue with this is that actually Tesla and Elon Musk actually want to bring their average selling price down in order to reach a wider market. So it's actually there's a potential for the average selling price to fall, or at least remain stable at $50,000, which in real terms would be a fall in price. And we'll consider what that would mean for the amount of vehicles that they have to produce or deliver over a same sort of revenue producing year. I've then said that by 2026, automotive revenue as a percentage of total revenue will represent 85%, despite the fact that actually automotive revenue is increasing. And then I've said that by 2031, it will represent 80%. As a result of that, that means that the number of vehicles that they need to deliver in 2026, if they're selling them at an average selling price of $64,000, would be 3.3 million. and in 2031 it would be 6.7 million. They would then achieve the final 20% of revenue through their other services such as insurance, energy storage, and maybe, who knows, maybe some subscriptions to full self-driving. Now, depending on where you look, the total number of new car sales for 2022 is estimated at somewhere between 75 and 80 million cars. Now, I think that by 2031, we'll see that figure increase to around 100 million. Now, of course, it's quite difficult to forecast that. It could be higher, it could be less. But I think that 100 million is probably a reasonable estimate to start with. As a result of that, in order for them to deliver that 6.6 million cars, they would need a market share of 6.7%. Now, their current market share sits at around 1.6%. And we can see that in the US and Canada, it's closer to 2%. But in Europe and China, it's a little bit lower at 1.2%. Now, they're actually building out their gigafactories in, I believe, Berlin and Shanghai. And as a result of that, we're expecting their market share in those regions to increase as well. But I think that over time, a 6.7% market share is not all that unreasonable, actually. I think it's quite a reasonable estimate. Now, to give you a little bit of perspective of what that actually means in real terms, now Toyota's market share, which is the global leader in terms of market share, sits at 8.5%. And you see I've taken that from here. Volkswagen sits at 7.8, BMW's is down at 2.7. Now, Toyota's is 8.5%. Now, the sort of, a little bit of not necessarily an issue, but something to consider here, is that Toyota's average selling price actually sits at around $29,000. In my model here, we're looking at an average selling price of $74,000. And therefore, is it reasonable to assume that that they can capture such a large market share with such a significant increase in average selling price? I would probably say no. So maybe a more reasonable estimate would be that actually their average selling price is going to stay flat between 2021 and 2031, which in real terms is actually a decrease in average selling price. And if that is the case, that means that they need to deliver 9.9 million vehicles in order to hit that $500 billion in automotive revenue. And as a result of that, that would be a 9.9% market share. Now, is that possible? I would say, again, it's possible, but is it probable? I'm not sure. Now, with that being said, the man himself, Elon Musk, actually believes that Tesla will probably make 20 million vehicles a year by 2030. That would make them the significant leader in all vehicles produced and delivered. And actually, that would put them at a market share of something like, according to my estimate anyway, 20%, which I personally don't believe. And I think you have to always apply an element of skepticism when you're listening to a leader of a business tell you what the business can achieve. And the reason I say that is because, once again, Elon Musk has been promising a lot. And whilst Tesla have been doing incredible things, and you have to give them a lot of credit for that, there's also things that they've said that they haven't been able to achieve, full self-driving being one of them, being promised since sort of 2017. So I think that you should always try and be rational and always try and apply an element of skepticism. But I think that 10 million vehicles is probably, it's possible, right? It's not absolutely ridiculous if they can keep their average selling price down. So then coming briefly back to the discounted cash flow. Now, I appreciate I'm jumping around quite a bit, but there is so much to cover. We've got an EBITDA margin in 2021 of 20%. In my model, I'm expecting that to increase up to 30% over the long term. And actually, for unlevered free cash flow as a percentage of EBITDA, it's 38% in the most recent year, and I'm expecting that to increase right the way up to 65%. In fact, that increases to 70%. So there's clearly a significant amount of operational efficiencies that I'm building into this model. So that brings us to an intrinsic value, according to the discounted cash flow, of $601, and according to a multiple of earnings, which is a PE ratio of 20 in 10 years' time, of $696. So that would suggest a price per share in 10 years of $2,300. Now, people are probably going to jump on that and say that in 10 years' time, the PE ratio of 20 is too low. And my counter to that would be that in my model, we're saying a growth rate of around 20% per year from 10 years' time and a net margin of around 19%. In less sort of exuberant markets, a PE ratio of 20 would absolutely be fair for that kind of business. That suggests a fair value per share of $648 or a margin of safety of negative 38%. So clearly, this is a stock, according to this model, that is overvalued at the current prices, if you believe the inputs to the model. So that's my personal prediction for Tesla. I was actually pleasantly surprised by the way that they've been able to scale their operations, increase their efficiencies, and actually for the outlook for the business still looks pretty good. With that being said, I do think that the share price of $1,000 at today, or $1 trillion market capitalization, is too high for what we're expecting to happen into the future. If we do see a decline in their share price, which is not impossible, right, considering how volatile this stock is, this is definitely something that I'm actually going to look into even further, which is a surprise to me, right, because I didn't think that I would be saying that. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.